Hello and welcome to the Tax Roundup for May. And on the 12th, the government is handing down the federal budget, the centrepieces of which we expect to be the Families Package with significant changes to childcare, and also the Small Business Package, which should contain a 1.5% or more reduction in the company tax rate. If you are on our database already, you'll get a copy of our budget summary on the 13th. If you're not, you can go ahead and subscribe. We'll look behind the headlines and look at what's of relevance to accountants, advisors, and of course their clients. But this month we're taking a look at two significant exposure drafts that have been released. The first is on the taxation of earnout arrangements, and the second one that'll have some impact on superannuation funds with reforms to manage investment trusts. We also look at two announcements from the ATO, the first of relevance to the building construction industry, and the second looking at a new data matching program that will capture a whole lot of eBay transactions. But first off, we go across to Michael Carruthers to look at the taxation of earnout arrangements.
One of the good news stories for this month is the release of draft legislation for the treatment of earnout arrangements. Now, very broad background here. Earnout arrangements are typically the term we use when you've got someone selling a business or business assets, and some of the consideration for that sale is contingent on future performance. So, for example, someone might sell their business and they receive an upfront sum, which is a fixed amount, but then they might be entitled to future payments in the next 2 or 3 years, dependent on the financial performance of the business over those few years. That's roughly an earnout. Now, there's been considerable uncertainty around the tax treatment of earnout arrangements, a lot of complexity about how the rules should be applied, and a lot of that stems from an ATO draft ruling that was issued a number of years ago. Since then, we've had both the previous government, current government release statements saying that those rules will be amended to provide some more certainty and simplify the process, and we've finally now reached the point where we've got some draft legislation. The legislation will apply to earnout arrangements entered into from the 23rd of April 2015. Those who may have entered into earnout arrangements prior to that date, since the government's announcements that there would be changes coming, were led to believe that they could rely on the new rules as well. The EM suggests that while they don't technically qualify, they will be given protection. So as long as they've applied the rules in good faith, based on their understanding, based on what the government has said already, they should be protected, and hopefully the treatment they've applied will be just left alone. Now, in terms of the rules themselves, there's really two big aspects we just want to have a quick look at. Firstly is qualifying for the new rules in the first place. There are some conditions that have to be met. To be a qualifying earnout arrangement, some of the conditions you need to look at are firstly that those future payments need to be contingent on financial performance. So if you have any future payments that are contingent on something that is not relating to financial performance of the business or the assets, then probably won't qualify. For example, if a business owner is required to stay employed with the business for 2 years, and that will entitle them to another payment, that's probably not going to qualify for the earnout rules. On the other hand, if that extra payment is contingent on turnover or profitability, that's the sort of thing that the earnout rules are intended to apply to. One of the other major conditions is that the earnout period can't go beyond 4 years. So as long as that period that's being tested and when those extra payments will all be wrapped up within 4 years, then that's one of the conditions that would need to be satisfied. Now, assuming we are dealing with an earnout arrangement that does qualify, the key fundamental aspect, I guess, of these new rules is that we'll be looking at a look-through application of the rules. So when we're trying to figure out the capital gain or loss on sale of the assets, that capital gain or loss will include the fixed upfront payment, if there is any, plus we will just bring in all the additional payments that are received in future years. Under the current rules, the ATO's approach is that you need to put a market value on that right, that intangible asset that gives you the right to possibly receive some future payments. That in itself causes some big difficulties in practice. These new rules will avoid the need for having to do that. So that should simplify the process and provide a fair bit more certainty, I guess, for taxpayers on both sides of the transaction. So look through treatment for both parties, the seller and the buyer. The way the rules look like they'll apply based on the EM is that if you receive additional proceeds in a later income year, you'll actually have to go back and amend the original tax return and put that in. That's a little bit different to what the previous consultation paper suggested. The rules around amendment periods are being amended to make sure that you will be able to amend your tax return within always a 4-year time period. The rules are also going to be softened around the making of choices in elections. So where you've made an election, for example, under the small business CGT concessions, it looks like there'll be some flexibility in order to amend or change or remake those elections in a later year where the capital gain or capital loss amount is actually changed. So there is still some complexity in the rules, not saying that it's going to be necessarily simple to work through, but it will simplify the process. It will remove the need to get those earnout rights valued, and it should provide greater certainty for the parties involved in the transaction to know exactly where they stand when it comes to the tax rules. So, good news story. We'll keep you updated on how things are progressing and whether there's any major changes by the time these new rules actually become law.
Another exposure draft amends the rules for managed investment trusts. Now, part of these reforms will amend the public trading rules, which will be relevant to some superannuation funds. Rae explains.
Today we're going to talk about MITs. Now, Treasury have announced some legislation in relation to MITs, which maybe doesn't apply to everyone, but included in the provisions are some proposed changes to how trading trusts will be treated. As you may know, if the units in the trading trust are owned 20% or more by a super fund, then it's treated like a publicly traded trust, basically taxed like a company. However, with these new provisions, it means that 20% rule, if superannuation funds are holding the units, then they will not be treated like a publicly traded trust. So that could be good news for clients who have superannuation funds.
From the ATO this month, Mike takes you through the changes to the taxable reporting payments deadline that'll be of relevance to the building and construction industry.
Another bit of good news for this month is the ATO's confirmation that the taxable payment reporting statements that are required to be made by some taxpayers, the deadline for that has been extended till the 28th of August for this year. So almost another month to put in those reports. Now, just a quick reminder, because it's the sort of thing we only look at once a year, these are the reports that need to be provided to the ATO, which detail payments made by contractors by businesses that mainly operate in the construction and building industry. So need to report to the ATO the details of those payments. It's an integrity measure, so the ATO can then match up the tax returns that those contractors are lodging. But in the past, there always has been a bit of concern around the deadline being 1 month after year end and the pressure that puts on clients and practitioners to meet that deadline. So almost a doubling of the time period that's available to do that. Still may have to get that process started prior to the time you would normally be looking at some of those clients' tax return matters. But at least there is that bit of extra time, but probably still a good idea to chase up clients and let them know what will be required to complete those reports sooner rather than later.
Finally, Rae takes you through the new data matching program targeting eBay transactions.
The ATO, as we know, make a lot of use of data matching, but now they're ramping it up a bit. So they are specifically asking from eBay details of transactions of total value of $10,000 or more throughout the 2014 tax year. They're expecting to get records from about 15 to 25,000 individuals. So if those individuals have a high degree of eBay traffic and a lot of things being sold, and that has not been reflected somewhere in their tax return, they are more likely to get a few questions from the taxman.
And that's the tax roundup for this month. Don't forget about the budget update. And also, if you want to keep on top of change, don't forget, if you're not a member of Knowledge Hub right now, then give Julie a call on 1-800-800-232. We will help you keep up to date with standards, work papers, precedents, plus also all backed up with a help desk and quarterly professional development as well. So give her a call and see what's on offer. We'll look forward to seeing you soon.